Okay, which question?
First one.
Okay. Under
So your screen
diversified.
is not visible.
Oh, okay, I'll share. Okay. Under diversified portfolios are not a potential implications of which of the following behavioral biases? Ah, Um, are not a potential implication. See, under diversified can be representative biases. Okay. Then illusion of control also possible under diversified, not diversified less. Illusion of control. Implication of which of the following behavioral biases? Yeah, so it should be not a potential confirmation because you are very sure which of the following not confirmation. Just
So
check.
what? Okay.
It is little. This kind of questions will be little tricky, but you check the answer. Confirmation.
No, it's A.
Representatives.
Yes.
Representativeness. It's not a potential. Implications of which of the following behavioral biases? Under diversified means you have less stocks, less company stocks. So that shows representative biases. They're saying that is not a potential implications. Illusion of control and confirmation. Okay, let me read the answer. Wait.
Yes.
Under diversified portfolios are consequence of both illusion of control and confirmation biases. Illusion of control is there. Researchers have found that some investors prefer to invest in companies that they feel have control over, such as the companies they work for, leading them to hold concentrated positions. Confirmation bias may lead to FMPs ignoring negative news, paying attention only to information confirmation that a company is a good company, good investments, which may result in large positions. Representative bias is not typically associated with under diversified. Representative bias representative bias is not typically associated. Representative bias. Under diversified portfolios are not the potential implications of which of the following behavioral biases: confirmation biases and illusion of control biases, but not representative biases. Representativeness bias is not typically associated. Representativeness bias is not typically representativeness bias is not typically associated with underdiversified. Is not typically associated with underdiversified portfolio. So that means
It's
diversified portfolio can also have representative biasness.
yes. Yeah.
Uh, this is very theoretical and
Yeah.
very. This is something we have to go for supervised learning. That means whatever they say, we have to accordingly change our mind
Yeah.
rather than because there will be very thin line difference between all this. Very thin line. Uh, Very thin line difference. On many times we will not even believe in that difference. It will not make sense also. Like now, after reading all this, still it is not making any sense to me.
Because all three of them mean the same thing that you're
Yeah,
choosing, favoring
yeah.
one security.
Hmm. Yeah. I still I'm not convinced with what they have written. Uh, Representative bias is not typically associated with well diversified portfolio. Okay. It's not at all convincing because under diversified only should have representative bias. How are they saying now bias? Okay, but this is the thing. What you have to do in this chapter is whatever you are able to connect. Whatever you are not able to, we have to forcefully now connect. Then there is no other way. That
Okay.
okay, in this case, this is how. Or let's see if it is in the curriculum if there is any way to find out representative bias. How will I know now? Yes, representative bias or under diversified. What is FMP? FMP.
I think it's fund manager or something.
Okay. But the problem is in this any line they can ask. That is the problem. Base rate neglect and sample size neglect are two types of representative bias that apply to FMPs. So confirmation bias, they build a large position, then appropriate and hold an under diversified portfolio. Confirmation. Okay. Then another option was representative bias. And what was the other option? Representative bias.
Illusion control.
So illusion control. It's not very convincing, but this is how this, because it's behavior related. Na? So
Hmm.
yeah, so this is the nature of the reading itself. Two forms of representative bias. So this will easily come under, I think, base rate neglect. Base rate. It will have base rate neglect. Representative bias is not typically associated with under diversified portfolio. Not very convincing, but as I said, you will get like this in many questions now. And
Yeah.
such kind of thing, we have to just go for supervised learning. That means whatever they say, that is the truth. No other way. Because if it is something really technical or mathematical, we can prove it, we can find out the logical reason. Here there is no logic. These all are behavioral biases. Okay, it is more to do with behavioral stuff, which, like certain behavioral stuff, we may not be able to associate only. So we just have to accept that, okay, in this case, this is how I am supposed to think. So here the point that you have to notice, that when it comes to under diversified portfolio, it is applicable for illusion control and what is the other one?
Confirmation.
Confirmation biases. It does not have representative biases. You have to rely more on your memory only here.
Okay.
Okay, what is the other question?
Third one.
Status quo bias. Status quo means you are not changing your thoughts. Is
Yeah.
least similar to which of the following behavioral biases? Is least similar. That means it is similar to two other biases. Status quo, regret aversion, certainly it is similar. Okay, regret aversion, it will be similar because uh, no, regret aversion. So no, regret aversion. Endowment is correct. Endowment is similar, and then regret aversion means to because of regret aversion is uh, confirmation and regret aversion. Status quo is least similar to which of the following behavioral biases? It is similar to endowment because if some parents or grandparents gifting shares to us, we don't tend to change it.
Yeah.
We don't tend to sell it. So that is status quo. Regret aversion means
Excessive fear.
uh,
So not taking any risk because of that.
excessive then again status quo, correct. Then least similar should be confirmation then. Then let's see. Okay, yeah, this is okay, fine. This is fine. Regret aversion is because of excess fear, not taking any decision.
Yeah.
Yeah, this is okay. First one is certainly not convincing. Similar, like, see, maybe like 30-40%, it will not be convincing for us. Remaining also, it will be quite difficult only to understand in this one. But then it is an important one as well. Okay.
Yeah.
Remaining one, somehow, after reading or on your own, or maybe after reading, you will get some conviction. Like here, it is okay. Like as I said, this is something okay, believable. We got the answer also.
Yeah.
Okay. But first one, not convincing. Like this 30-40% you will find in this topic. Okay. What is the next question?
Eighth one.
Eighth one. Okay. Which of the following is a likely consequence of Kai's approach to manage his finance? Concentrated portfolio positions, foregone opportunities to reduce risk by combining assets with low correlations, excessive trading. Okay, so it is a part of this question, right? The case study. Okay. Which of the following is likely a consequences? Which of the following is likely a consequences of Kai's approach to manage? Concentrated portfolio, foregone opportunities, and excessive trading. Okay. So Katrina Dowsri is a portfolio manager for International Bank. Okay. Where he advises high net worth clients. Dowsri is meeting with a new client. Dowsri is meeting with a new client. She advises high net worth individuals. Okay. Dowsri is meeting with a new client. STO Kai. So Kai is a client. A 40-year-old surgeon with 4 million across various accounts and a salary of 500,000 per annum. Okay, Kai explains to Dowsri that he has 4 accounts at 4 different banks, each with specific sources and uses of funds as shown in the following table: salary, living expense, bonus, charitable, portfolio interest, savings, portfolio dividends, mother's living expenses. Now the question is, which of these following is likely a consequences of Kai's approach to managing his finance? Concentrated, uh, foregone opportunities to reduce risk by combining assets with low correlations. Um, Concentrated portfolio positions, excessive trading, 4 accounts at 4 different banks, with each specific sources and use of funds as shown. Salary account is for living expenses, bonus is for charitable gift, portfolio interest is for saving for retirement. Excessive trading, I think it should be B. Foregone opportunities to reduce risk by combining assets with low correlation, because uh, that's what I think. Which of the following is likely consequences of approach to manage his finances? Because it is not concentrated as such. It is all different amount. There is, we cannot say he is trading and all. He's not
Yeah.
excessive trading. Foregone opportunity, because he is not analyzing risk over here. All he is doing is portfolio interest is for saving. So there is no risk reductions. Let's see. Eighth question. Eighth is B.
Yeah. Okay.
Ah, okay. Let's read the answer also. The most common consequences of mental accounting. Eighth one. Na? The eighth. The most common consequences of mental accounting is neglecting opportunities to reduce risk by combining assets with low correlation. Because each account's asset allocation is examined discretely. It is examined discretely. Offsetting positions across accounts or an overall inefficient allocation with respect to risk can lead to suboptimal aggregate performance. Suboptimal aggregate performance. Okay. Offsetting positions across accounts or an overall inefficient allocation with respect to risk can lead to suboptimal aggregate performance. Hmm. You understood this one? Basically, this is
Yeah.
what I was telling,
Yeah.
in fact, that you are not focusing on risk over here. You are just going by salary, living expense. That means you are not seeing, like, you are not optimizing no amount.
Right. Yeah.
You are not optimizing amount. You are just saying, this is my salary. The salary is for living expense. Bonus is for charitable. So this amount has not been put into the best use. As in, like, let's take this much risk. With this risk, this much return will come, and then that money will be used for this much, so and so expenses. That way, there is no combination. So the risk reduction is not there. The most common consequences of mental accounting is neglecting opportunities to reduce risk by combining assets with low correlation, because each account's allocation is examined discretely. Yeah, because all these are examined discretely, separately. So there is no combination, or there is no risk reductions. Yeah, offsetting positions across accounts or an overall inefficient allocation with respect to risk can lead to suboptimal aggregate performance. Okay, fine. So that is the point here.
Okay.
Foregone opportunities to reduce risk by combining assets with low correlation, because he is not doing any trading here. So you can eliminate. See, concentrated portfolio position, it is not concentrated. See, he is invested into bond, he is invested into equities, right? Equity will give dividends, bonds will give interest. And this one, no idea. That's why it is not optimized properly. Okay.
Okay.
Yeah. What is the next
Yes.
one?
Next one, ninth.
Ninth one. Which strategy should Dowsri use or recommend to Kai? Keep written records of investment decisions. Ask questions such as, is the decision the result of focusing on a net gain or net loss? Uh, Aggregate all accounts and portfolios into a single spreadsheet. Okay. It's not, which strategy should use or recommend. This is not going to be the one that keep written records
Yes.
and all that thing. Ask questions such as, is the decision the result of focusing on a net gain or net? Aggregate all accounts on this makes sense. Is the decision and the result of focusing on a net gain or net loss position? Is the decision the result of focusing on a net gain or net loss position? Ask questions such as, is the decision means which strategy? Okay, the decision that they are using so many accounts, is it because, is the decision the result of focusing on a net gain or net loss? No, again, it is not making sense. Aggregate all accounts and portfolios into a single spreadsheet so that you will know how much risk you are taking, and you know how to reduce all those risks, because finally you have to club all money together. You cannot separate money saying this money has this importance, that money has that importance, because any money can be used for living expenses. Any money can be used for charitable gift. Any money can be used for saving. Even this is the mistake, that people make. You must have seen people saying, I'm investing for my child's future education, like this.
Yes.
Have you heard like this? People will say, this is for my child's future education, or when my child will grow up, it will be for her. And then they will invest into some sort of mutual fund. Now it doesn't matter whether you are investing, some sort of, or people will say pension fund, that it will be helpful for your retirement. But those are all mind games finally, because even your mutual fund can help you in retirement. Why only pension fund?
Yeah.
So finally, money is money. Why do you have to, invest only in pension funds and get only 8%? Around 8% only you will get in pension funds or provident funds and all. And then people will say, no, this money I have kept it for my retirement. But money is money. How does it matter whether it is a provident fund or else mutual funds? So even mutual funds, you are getting more returns now. You understood what I'm trying to say here?
Yes.
That same money, when you are investing in mutual funds, you are getting more returns. That means you are losing the opportunity. Okay, you are losing the opportunity, and you are thinking that, okay, my provident fund will take care of my retirement, whereas mutual fund also can take care of your retirement. So finally both are money only. Okay, and if you are ready to wait, like the way you are ready to wait in pension funds or provident fund, in mutual fund, if you are ready to wait, you will get even higher return, much higher return. And in the long run, the risk will also be comparatively lower then. Okay. Why so? Because in the long run, the returns tend to grow easily, right?
Yeah.
So ninth one, aggregate all accounts into a single spreadsheet. Yeah. So this is, you can connect with people who will say, I have kept this account for my for my child's education. I have kept that account for travel and tourism and all that thing. So they have uh, this that is also mental accounting bias only, actually. Mental accounting bias. So use, okay, so aggregate all, because in order to avoid that mental accounting, you should aggregate all this. Okay. Here it is given. Okay. Only two-line explanation. Okay. Aggregate mental accounting is a logical strategy to combat mental accounting. Yeah. It is the opposite of disaggregating money into separate accounts. You understood this one again, mental accounting, because these are all example of mental accounting to say that this money is for living expense and this money is for charitable gift. These are all our mental accounting. Finally, money is money, and any
Right.
money has
Yeah.
equal importance. Thousand is thousand. Thousand has equal importance, be it in salary or bonus account or interest or dividend. In the market, 1,000 rupees is 1,000 rupee only. It doesn't matter whether you got it through interest or dividends or bonus or salary.
Okay.
Okay. Yeah. What is the next one?
10th one.
Okay. Which of the following individual behavioral biases most strongly associated with market bubbles? Market bubbles should be overconfidence. Which of the following behavioral biases most strongly associated with market bubble? Market bubble should be overconfidence.
But it could also be
Huh,
framing, right?
huh, huh, huh?
It could
No,
also be framing.
no, there is bubble in the market. Framing is, framing is different. No, framing is how you are framing words. Practically, the market might be in bubble, might not be in bubble.
Yes.
You are just
Yeah.
framing it. Overconfidence means what? When there is bubble in the market, everybody is overconfident that they will make money.
Okay.
This is okay, fine.
Yeah.
Because framing means the truth might be anything. You are framing it. Bubble means you are being overconfident,
Okay.
because that's the time people will invest more and more, no? Because they will think that market will never go down. So that is their overconfidence.
Okay.
Okay, what is the next one?
12th.
All of the following are reasons that an apparent deviation from the efficient market hypothesis might not be anomalous, except all of the following are reasons that an apparent deviation from the efficient market hypothesis. All of the following are reasons that an apparent deviation, that an apparent deviations. All of the following are reasons that an apparent deviations from the efficient market hypothesis. All of the following are reasons. Okay, are reasons that an apparent deviation from the efficient market hypothesis might not be anomalous, except is very irritating.
Yes.
Uh,
Yeah.
might not be anomalous, except. That means one is anomalous. So, in short, the question is the apparent deviation from the efficient market hypothesis is anomalous. That is the question. So, which is anomalous? Okay. Abnormal returns represents compensation for exposure to risk. Represents compensation for exposure to risk. Okay. Changing the asset pricing model makes the deviation to disappear. Apparent deviation from the might be might be anomalous. Okay, first is possible. Changing the asset pricing model makes the deviation to disappear. Okay, asset pricing model makes the deviation to disappear. The deviation is well known or documented. If the deviation is well known and documented, then it is not deviations, then it is not anomalous only. So the question is which one is anomalous? Right, which might not be anomalous, except that means which one is anomalous. So C will not come because if the deviation is well known and documented, then it is not anomalous. So between A and B, if I see, the abnormal returns represents compensation for exposure to risk. Changing the asset pricing model makes the deviation to disappear. That is also correct only. I think A, abnormal returns represents exception compensations for exposure to risk. Okay, I think A. Let's
It's C.
see. Okay, C. The deviation is well known or documented. Then it is not anomalous if it is well known. Bubbles and crashes are well known and well documented phenomenon, yet represents market. Yeah, see again, this is not believable. They themselves are now going against it. They are saying well known and well documented, and then they are saying yet represent market anomalies. Still, it represents market anomalies. That means it's again a memory. It has no connection with the logic then.
Right.
Bubbles and crashes are well known and well documented phenomenon, yet represents market anomalies. Okay, this is that means this is market anomaly. These two are not market anomaly. Okay. What I was thinking is the abnormal return represents compensation. What I was thinking, uh, what I was thinking is, I'm not able to write 1 minute. Okay, not what I was thinking is this forms like this C. So I thought here, if this is the uh, if this is the standard deviation and this is the return. Okay. I thought here it is forming the shape of C. Na? So here the risk that one is taking, this risk, if you see here, this risk is bigger than the increase in return. So increase in return is only this much, and the risk is this much. So comparatively, the risk is high and the return is lower. But here it says the abnormal return represents exposure to. Okay, but still it is abnormal return. Okay. So I thought it is okay. The abnormal return represents compensation for risk to for exposure to risk. Okay, I was thinking about this diminishing utility, but
Okay.
then okay, but then that's not what they meant. They are not talking about that. All they are saying is abnormal returns are there. So which is not okay. That means that is not an anomaly. Changing the asset price model makes the deviation disappear. That is also not. In short, all three are not anomaly actually, but they said this is not. This is well documented, but yet this is considered as anomaly. That is the explanation, which is again not convincing.
What does the second option mean?
Changing the asset pricing model makes the deviation to disappear means now you can model the price of the asset in different methods, right? You may use CAPM method, you may
Yeah.
use dividend discount model, you may use Gordon growth model, you may use the net asset value model, you may use relative price model. So the price will be changing in different model. Okay, so imagine the price of the stock is 100 rupees now in the market. If the price of the stock is 100 rupees in the market, and using dividend discount model, you get to know that the price should be 110. That means the stock is what, undervalued. Now
Yeah.
using net asset value, you will get to know that the price should be 90 only. Then 100 is overvalued now.
Yeah.
So different method will give you different answer.
Okay.
Okay, because of which, you know undervalued stock might become overvalued also. So deviations will disappear, or some other method might give you directly 100 only around. So there is no, so now it is correctly priced.
Okay.
Okay,
Understood.
so this one is again memory based. uh, Bubbles and crashes are well known and well documented phenomenon, yet represents market anomaly. So yet, so they themselves are
Contradict.
contradicting, yet represent market anomalies. Okay, so this is memory. That means, what is the next one?
13th one.
13th one. Okay, investment managers incentivized or accountable for short-term performance by current and prospective clients is a potentially rational explanation for which of the following? Investment manager incentivized or accountable for short-term performance by current and prospective clients. Investment managers incentivized or accountable for short-term performance. by current and prospective clients is a potentially rational explanation for which of the following: investment managers incentivized or accountable for short-term performance by current and prospective clients is a potentially rational explanation for which of the following: it is not home bias, value stocks underperforming growth stocks. Investment managers incentivized or accountable for short-term performance by current and in prospective clients is a potential rational explanation for which of the following: value stocks underperforming growth stocks. Investment managers incentivized or accountable for short-term performance by current and prospective client is a potentially rational explanation for which of the following: home buyers bubbles value stock outperforming growth stocks. Investment managers incentivized or accountable for short-term performance by current and prospective clients. That that line explanation meaning itself
The question, yeah.
question, yeah, not making sense only. Investment managers incentivized or accountable for short-term performance by current and prospective clients is a is a potentially rational explanation for which of the following: home buyers bubbles value stocks outperforming growth stocks. Hmm. Investment manager incentivized or accountable for short-term performance by current and prospective client is a potentially rational explanation for which of the following: value stocks outperforming growth stocks. Question itself is not understandable, then how can we get the answer? Investment managers incentivized or accountable for short-term performance by current and prospective clients is a potentially rational explanation for. If I have to still select something, I would have gone for home bias potential. Let's see, but I'm not very sure with the question itself. B. Okay, it is B. Bubble. So what is the explanation? Investment managers Investment managers' incentives, or perhaps more accurately, their perception of their incentives for short term performance, were named as consideration in the technology and real estate bubbles. Not participating in the bubble presented certain FMPs. What does FMP mean again? Let me just see. Financial market participants. Okay, FMP is financial market participants.
It's page number 239.
Hmm. Questions here, no? Okay. 13th question. Investment managers incentives perhaps more financial market participants, certain financial market participants with commercial or career risk. Investment managers' incentives, or perhaps more accurately, their perception of their incentives for short term performance, were named as consideration in the technology and real estate bubbles, not participating in the bubble represented. Okay. That means investment managers incentivized or accountable for short term performance by current and prospective clients. Is a potentially rational explanation for which of the following? Even after reading the answer, the question is not very convincing. The answer says that their incentives are more often dependent on the short term bubbles. The short term performance were named as consideration. So answer is also fine, but still question is not convincing. Incentivize or accountable for short term performance by current and prospective clients is a potential rational explanation for which of the following? I'm not very convinced with this question. Anyways, as I said, you will get 30-40% question like this. Okay. Not making sense, this one, after reading so many times also. But you understood the answer that they are trying to say, that investment managers incentives is most of the time dependent on short term basis. It is dependent on the, see, is dependent on the bubbles. Their perception of their incentives is dependent on the bubbles, because if they don't participate in the bubble, then they might put their career at risk. They will not get that incentives. So in spite of knowing that it is a bubble, they might have to invest in such stocks,
Okay.
short term basis. Okay, short term basis, because they, otherwise they will be considered as a fool. Okay,
Right.
but am I getting that idea when I read the question? Still not. This line, accountable for short term performance by current client, is potentially a rational explanation, is not still making sense. But all they are trying to say is like, even after knowing that it is a bubble, sometimes investment manager, they have to invest because they cannot, otherwise their career will be at risk.
Okay.
Okay, so not very convincing, as I said. You just have to remember this kind of question. What is the next one?
14.
momentum can be partly explained by the following behavioral biases, except momentum can be explained by availability possible, because what stocks are going up, people are investing in that one. So this will should not be the answer. Regret also should not be the answer, because people don't want to regret, so they will keep on investing. So it should be home bias. Seems to be okay. Home bias. Yeah. This is little easier only. Okay. Momentum can be partly explained. You understood this one?
Yes, yeah.
Okay. Because that only people are seeing that stock only going up, so they tend to invest even more. That is availability. And regret, because people don't want to miss that opportunities. Home bias, momentum, not necessarily that it will happen only because of home bias. There are many stocks which are not home biased, but still it will go up. No, there are many ancillaries making stocks, not branded small cap company stocks, which we don't directly use the product. Indirectly we might be, not directly. That means we might not know the raw material supplying companies. We might not even know their brand name.
Okay.
But still such stocks can be in momentum, or many IT companies might be in momentum. That doesn't mean I'm using in my home that IT company.
Right, yeah.
Okay, what is the next one?
That's it.
Okay. Okay. Just 1 minute. Okay. So now we will continue this for some time. This portfolio management then. Okay. You have time, right? Is it okay? Hello. Hello. Hello.
Hello.
Can you hear?
Yes, sir.
Okay. So you have time, right? Shall I continue for some more time?
Yes, sir.
So we are supposed to begin from uh, where are we supposed to begin now from?
150 page.
What is that LOS?
87.
Okay, so we are supposed to begin from this reading.
We've done the first half of this.
Okay, done. Cognitive error, yeah, this we did. Representative bias also we did. Mental accounting, I think we didn't do, right?
We
Hindsight
did.
bias, we did. Mental accounting.
Emotional biases, I think we have to start from.
Okay, emotional biases, okay. So again, this is more or less some overlapping you will find. Loss aversion bias means what? Loss aversion bias means I'm okay for loss, but I'm not, as in like, no, not okay for loss. Like my 10 percentage gain makes me happy, but 10 percentage loss puts me into coma. It doesn't make me sad. It puts me into coma. So you are seeing the difference.
Yeah.
10 percentage gain is making me happy. 10 percentage loss should make me only sad, but it puts me into coma. That means I'm taking my loss more aggressively, more seriously. That is the human tendency. Okay, so that is called loss aversion bias. Not ready to treat profit and loss equally. We don't treat profit and loss equally, right? We take losses more seriously, more severely. Okay, so loss aversion, that is loss aversion bias. Feeling from more pain from a loss than pleasure from an equal gain. That behavior is called loss aversion. Okay, loss aversion bias. You can read this one to get more conviction, or you can read later also peacefully, because all these are self-explanatory only, not difficult. But yeah, when you face questions, they will play around with words. Then it will be little irritating there that time. But when you read, learning is not difficult here. Facing
Yeah.
questions is the challenge here. Overconfidence, the name itself says overconfident bias. So it can show up as illusion of knowledge, okay, knowledge or self-attribution bias. Individuals may give themselves personal credit when things go right. Like for example, imagine last year, before 1 year, market was in bull run, everybody was making money. So if you are making money for 1 2 months, you will think that you are the master of the financial market. So that is overconfidence bias comes. Whereas that is what? That is just an illusion. Okay. You cannot, be a newcomer and then master the market in few months. But people normally get this feeling. Self-control bias. So self-control bias, again, you are thinking that nothing will go wrong in this company. Okay. Occurs when self-control bias occurs when individuals lack self-discipline and favor short-term satisfaction over long-term goals. Okay, so that is self-control. Short-term satisfaction over long-term goals. Often individuals are not prepared to make short-term sacrifices to make their long-term goals. They may favor small payoff now at the expense of larger payoff in the future, which is known as hyperbolic discounting. Okay. When individuals lack self-discipline and favor short-term satisfaction over long term. Often, individuals are not prepared to make short term sacrifices to make their long term goals. They may favor small payoff now at the expense of larger payoff, which is known as hyperbolic discounting. You understood this one? Meaning that means you are giving more importance to your short term
Short-term
gains.
gains, okay. Yeah.
Okay. You can remember this term also, hyperbolic discounting. So, it can be because of insufficient savings, also possible. Then status quo we have already discussed, right? Status quo means you are not making any changes. Status quo is more like conservatism, overlapping with conservatism. Then endowment bias is my parents gave me this stock, so I will never sell. That is endowment. Or my grandparents gave me this, gifted these stocks to me, I will never sell. That is endowment. Regret aversion bias. This you already said, right? Excessive fear. Yeah, this is the key word. Nothing, do nothing out of excessive fear that actions can go wrong. Okay, so herding behavior means just following the crowd. That is herding behavior. But how are they saying this as regret aversion? On one side, they are saying do nothing, and on the other side, they are saying herding behavior is a form of regret aversion, but participants going with the census. So,
No, because they don't want to be left out. So they just go with the herd mentality.
it connects with herding behavior. That is right.
Hmm.
But then, how is it? So, it says do nothing out of excessive fear. Here it is following the crowd, na? So those are contradicting. Here it says do nothing. Here it says following the crowd. Both are different line, correct?
Hmm.
Both are different only, no? So do nothing out of excessive fear. That means whatever is happening in the market, you are not participating. Here it says participants will go with the consensus.
Yeah, it's contradictory.
Mhm. Herding behavior is fine, but it should not come under regret aversion bias, I think. Do nothing out of excessive fear. These are all the problems, okay, in this chapter. So this is not tough, but twice thrice probably you have to read, and the important one as well. So twice thrice you have to read. It will be terribly boring, and it will be as if like you are reading some unintellectual topic kind of thing. It will be. But how you can motivate yourself is this: you can apply it in your personal life also. Personal life as in when you're in your personal investments. When you are doing investments, you should know that you can have all these kind of biases in your behavior. Okay, so you should know that probably at times you are overconfident in your investments. Probably at times you are following herding mentality. Probably at times you are doing mental accounting. So that time you can realize all these things, that these are all the biases that I'm going through now, and that will help you to take decisions better.
Hmm.
Okay, uh, halo effect. Halo effect is a version of representativeness. Okay, this also then you should remember. It's a version of representativeness in which a company's good characteristics. So it is a version of representativeness that is important now. Now, halo effect means what? All goods, every aspect of the company is so good that the price has gone very high. And now, because the price has gone very high, now that becomes a bad stock to invest in. So, all good qualities only making it a bad one. That is halo effect. Okay. All good quality only making it a bad one. Understood this one, what I said? All good qualities is making it expensive. That
Yes.
because the price would have gone very high.
Okay.
Okay. leading to, see this, overvaluation of growth stocks. Then home biases means you are investing in those stocks which you are using in your home or you are seeing around. For example, I will invest in ICICI Bank because it is only outside my home. So I trust this bank. There might be other banks which are not there in the city also, but still might be doing very well. No?
Yeah.
So that you will not consider. That is home bias.
Okay.
That means I will, whatever I am using the product that I will use. But see, remember, biases doesn't mean all biases are bad. It is just that uh, you have to identify, recognize it, and understand it. Because every person will be biased in some or other way. Okay, every person will be biased in some or other way. We just have to know that we might be biased in this way here. Because when you are aware about your behavior, that will help you to make more conscious and better decision. That is the purpose here. It is not saying that all biases we can remove. We cannot remove all the biases because every behavior will have some biases. Okay, but we should be aware about it, and yeah, whatever we can remove, we can remove. Like for example, mental accounting, such kind of biases we should remove. Okay.
Yes.
Yeah, introduction to risk management. Introduction to risk management. Have you read this one?
No, sir.
Okay. Risk management. Risk management framework. This is all okay. Yeah, they may ask. They may try to again confuse with the word risk. Risk refers to this one or two line you have to know. Senior management's determination of the risk tolerance. So risk governance refers to senior management's determination of the risk tolerance of the organization, the elements of its optimal risk exposure strategy, and the framework for oversight. Okay, just read this one. Just I'll connect the charger to the laptop. Just you continue
Okay.
reading this, read this risk tolerance also.
Done, sir.
Done. Then risk budgeting is the process of, so they will give you these words and then they will try to confuse you with the meaning, whether identify whether that is risk budgeting or risk governance or risk tolerance. Like this they will try to confuse you. So risk budgeting means allocation. Okay, budget means what? Allocation. It is just like we plan for the budget when we go for a trip. That means where, how much money should be allocated, how much money should be for what mode of transport we should use, whether we should go by train, plane, buses, where to stay, where to eat, so that it falls all within the budget. That is allocation of resources. So allocation of resources is budgeting.
Okay.
Okay. Then tolerance, risk tolerance is setting the overall risk exposure. That means it is like this. Risk tolerance means we will spend 10,000 in the maximum budget is 10,000. So risk tolerance maximum we can spend 10,000 for the trip. Now in that 10,000, how to utilize that 10,000 most efficiently? So we will go to this place. We will stay here. We will eat this. All these are budgeting. You're getting the difference.
Yes, sir.
Tolerance is 10,000 and Budgeting is how to use that 10,000. Okay. And risk governance refers to senior managers' determination of the risk tolerance of the organizations. That 10,000 they are deciding based on some risk tolerance or risk governance ability, like how much the company should afford to spend. Okay. So that difference is key words you have to remember in all these things. Okay. Then financial markets are categorized into these three. Financial risks are categorized into these three: credit risk, liquidity risk, market risk. Credit risk means company, not able to repay. Credit risk. Liquidity means you are not able to sell the assets. That is liquidity risk. Market risk means, like, because of tariff war and all that thing, the price of the stock may go down. Then it is called as market risk. Okay. Then rest all are non-financial risk. You may remember like that. Rest all are non-financial risk. Non-financial risk. Now that includes what? You understood these three: credit risk,
Yes.
liquidity. Market means because of war, or COVID, because of the market, the company's stock price is down. Not because of the company, because of the market. Non-financial risk means operating risk. Operating means back office work or cyber security risk. All that will come under operational risk. Okay, because cyber security is connected to IT, that is also considered as operations. Then solvency, regulatory. You can just remember that, as I said, these three are financial risk, rest all are non-financial risk. That is a better way. Fine, okay. Then,
Okay.
so rest all are non-financial risk. Remember like that. Then mortality risk means risk that the person will be uh, risk of death. Mortal means death. Okay. For individuals, risk such as risk of death prior to providing for their family's future needs. That is mortality risk. Okay. So before a person makes enough uh, things for their family's requirements, if a person dies, that is called mortality risk. Longevity risk means the person is not dying only. That is also a risk. Why that is also a risk? Then his expenses will go up in medical expenses. He will be unproductive. Right? Those all are
Yeah.
longevity risk. A mortality risk, longevity risk. Okay, standard deviation, anyways, now, right? But can
Yes.
you understand this one? Negative skewed and positive skews. Negative skew. Okay. Standard deviation may not be appropriate measure of risk for non-normal probability distributions, especially those with negative skewed or positive. Excess kurtosis, fat tails. Okay, this is a good point that standard deviations may not be appropriate.
Or it can be in the extremes. Is
Huh.
that what you say?
Yeah. Hmm. Beta also we have seen already. Duration we have seen in fixed income. Beta is covariance by variance.
So it captures the volatility.
Yeah.
Okay.
Standard deviation comprises of systematic as well as non-systematic risk. Standard deviation is a broader term. So beta is a systematic risk.
Okay.
So beta is also playing a role in the volatility.
Okay.
Derivative risk. Okay, delta, gamma, vega, rho. So this one, I'm not able to write on the board. I have to, some connection is loose. Just give me 1 minute, okay? Let me connect and then I'll explain this part. Just give me 1 minute. Hello.
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 Yeah. We're there. Yeah. Okay. One minute. Hello.
Hello.
I think there is some loose connections. I'm not able to write on screen. Again, start. Okay, now it's working. It's working. Yeah. You can see the screen, right?
Yes.
Hello.
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 Ah. Uh, I'll share the screen now.
Okay.
You can see the screen now, right?
Yes.
Okay. So now, what are these risks? Uh, delta. Delta means sensitivity of derivatives values to the price of the underlying. Delta is equal to change in the change in the option price based on change in the stock price. That means, let's say 10 rupees option has changed from 10 rupees to 10 point, let's say 05, 10.5 for 100 to 100 and 101. So zero point 0.5 by 1. So zero point 0.5 is the delta. Is it okay? Option price has changed from 10 rupees to 10.5 rupees for 1 rupee change in the stock price. Understood this one?
So change in option price.
Yes,
Okay.
because of the change in stock price.
Okay.
For 1 rupee change in the stock price, what is the change in the option price?
Okay.
This is delta. Okay. Then next is gamma. Gamma is sensitivity of delta to changes in the price of the underlying. What does that mean now? So this topic is little technical, but still I would say better than those theories. Okay. Gamma is equal to change in delta based on change in the stock price. So what does this mean now? Stock price. So change in stock prices. Now 101, from 101 it goes to 102. Now when it goes from 101 to 102, stock price, this option price is going from 110.5 to, let's say, 10.8. So what does that mean? Uh, Initially there was a change of zero point 0.5. So let me write here like this: 100, 10 to 10.50, and then 10.80. Here 100 to 101, and then to 102. So change here, it is 0.5, and here it is 0.3. Okay, change. Uh, yeah, zero point 0.5 and then 0.3. Now this change in the change in the this is delta, right? So change in delta, which is what, 0.2. Change in delta, okay, based on the change in the stock price. You understood this meaning? So gamma is the second derivative of delta. First is delta, second derivative is gamma.
Okay.
Okay, gamma is the second derivative of the change in stock price. First derivative is delta. So the rate at which delta is changing, that is called as gamma. Okay, I should yeah, the rate at which delta is changing, that is called as gamma.
Okay.
The next one is vega. Vega is change in volatility based on change in stock price. So volatility means, initially imagine the volatility, no? Change in the sensitivity of derivative values to the volatility is wrong. Vega is change in option price based on change in volatility. Okay, that means now option price is moving from 10 to 10.5, when the volatility is moving from 20 percentage to 21 percentage. So because of the change in volatility, what is the change in option price? Okay, because of the change in volatility, what is the change in option price? This is called vega. Is it okay?
No, so I didn't understand Vega.
Okay. So stocks volatility is changing, right?
Yes.
Initially, its volatility was 20 percentage. Volatility means standard deviation, you think.
Yes.
Now the standard deviation changed to 21 percentage. So because of the change in volatility, how much the stock price is changing?
Okay.
Then next one is rho. Rho is change in, again, option price because of risk free rate. Okay, change in option price because of the change in risk free rate. That means this is not very like often used one. Volatility is all used highly. Change in option price means, let's say now interest rate is 5 percentage risk free, it has become 6 percentage. So how much the option price is changing? So from 10 it has gone to 10.5, imagine. So this is rho, change in the option price because of the change in the interest rates in the market.
Okay.
So here they have given like a statement, I have given like a formula kind of thing, so that it's easier to remember. Then tail risk, that means downside. I have told you, right, conditional var and
Yes.
conditional var. So var is this one. It will have three characteristics: that minimum loss, what else, there is minimum loss probability. Okay, there is, let's say, 5% probability. Let's say there is 5% probability that the minimum loss will be that the minimum loss will be uh, 2%, or it can be in the form of amount also. No, minimum loss will be 5,000 in 1 year time period. In 1 year time period, it can be 1 year, 1 month. Okay, so that means minimum loss, then probability, and then time period as well. It comprises of all this. Okay, and if this war happens, is hit, the further loss that you can suffer, that is called as conditional war. And the conditional war will tell you the average loss. This will tell you the average. Okay, average loss further. Expected loss or average loss, whereas var is minimum loss. Okay, minimum loss.
Okay.
Minimum loss. They will try to confuse, okay, with this minimum, maximum, all that thing, average. Whereas conditional var is expected value. That means average. Okay. Tail risk is a general term which shows downside risk. That includes conditional var and value at risk both.
So can you show the formula for delta and gamma? I'll just write it down.
Huh.
Done.
Yeah. Okay. So now you may just read all this quickly, see if you are okay. Or you read later on. Anyways,
Yeah. Okay.
later on you peacefully read and ask questions. Okay.
Okay.
Then let me see how much is left out. I think we will finish this one. Okay. Now scenario testing and stress testing. Uh, okay. Both are important, I would say. Stress testing examines the effects of specific extreme change in a key variable, such as interest rate or exchange rate. Stress test means if one variable changes highly, the key variable, how will it impact your business? Say, for example, what is the key variable for your airline industry? Oil price. Okay, key variable for the airline industry is oil price. So if oil price keeps going up high, then how far can it sustain? That is called stress testing. Let's say if oil price goes to $120 per barrel, then it can still sustain. Beyond 120 it cannot sustain. That is called stress testing. Okay.
Okay.
Any one key ingredient, key variable we will take, and then we'll see extreme cases to what extent it can tolerate. What is the key variable for your bank? interest rates. Okay, so if interest rates keeps on going high, very high, then can this bank sustain or not? That is called as stress testing. Okay, so in this case, we are putting one variable at an extreme condition and we are trying to find out to what extent the company can sustain. Okay,
Okay.
then scenario analysis means we are putting multiple variables at extreme case. Okay, that is scenario. Multiple variables means what? Unemployment is very high, GDP is very low, interest rate is very high, war is also going on. So in all these cases, can your company survive? Then it is called a scenario analysis.
Okay.
Okay, what if analysis of expected loss? So this is for multiple inputs. Okay,
Okay.
then see this one practically if you want to know. In fact, I think it has been now 1.5 years or so. Before 1.5 years, when the market was in all bull run, that time SEBI came up and put mutual funds at a stress test. They asked mutual funds to reveal every week, worst to worst case situation, can they sell all their investments in the market or not? How much time it will take for them to sell their investments if people are asking for the money?
Mm.
So some fund said it will take one week. Some fund said it will take 1 month. So those were all stress testing. What you can do is in just YouTube, just type stress testing mutual funds, something like this. You type, you will get many videos, debates, business debates on stress testing. So you
Okay.
will get more idea, more practically you will be able to connect, and you will not forget as well. Okay, so
Okay.
what I would suggest is you watch that video. Just type in YouTube stress test mutual fund SEBI, something like this. You type. These are the keywords. You will get plenty of articles. So 1.5 years back, this debate was going on when the market was at a very high, at the peak. Now, last 1 year, there is nothing happening in the market. Okay, so before that, it has been now I think 1.5 years. Okay.
Okay.
Then after that, I think there is nothing. These all are nothing self-explanatory only. Surety bond means an insurance company has agreed to make a payment if a third party fails to perform. So if a third party is failing to perform, for example, a company may be exposed to losses if a key supplier does not deliver on time. So you understood this one, self-explanatory. If the supplier
Yes.
is not delivering on time, then this insurance company will pay. That is called surety bond. Then fidelity bonds. Insurers also issue fidelity in which will pay for losses that result from employee theft or misconduct. So employee is doing some sort of theft or misconduct. Then fidelity bond will help you. Okay, just go through this one. These are self-explanatory only.
Okay.
Okay, fine. Next one. Is it still there? Okay,
No,
that's
it's
it.
fine.
Over. Portfolio management is over. That's it. So now then, tomorrow then we'll begin with FSA then. So FSA is only the bigger chunk. Okay, that might take maybe like 2 weeks. It might take 2.5 weeks.
So, before FSA